Live from.
With me now, Andre Cilliers from TreasuryONE. Thanks so much for joining us here on Biz News, Andre. Let's start with the US jobs data, weaker than expected, but it doesn't look as though to prevent the Fed from going ahead with its tapering modus operandi. Would you agree?
Yes, I would. Those figures are actually quite interesting because if you look at the unemployment figure versus the non-farm payrolls, then the unemployment figure is actually lower, but the non-farm payrolls came in at a very much lower figure as well. So a bit contradictory, and hence the people are expecting the Federal Reserve to continue with their tapering during November. So no change expected from the Federal Reserve side at all.
Now, inflation, stagflation. Let's unpack this a little because it looks as though the train has bolted from the station. Everybody is looking to inflation with a sense of alarm and saying that, if we go as far as stagflation, where you're looking at a low growth rate, high unemployment, high inflation, we're in a very difficult position globally. Where do you stand on this side of the equation?
Well, I think my personal opinion is that, the central bank should just actually get rid of all this quantitative easing that they've done. They should actually increase the interest rates to try and curb the inflation, to avoid the stagflation. This consistent avoidance of increasing interest rates in the name of growth, I think, is the wrong path to take. And that's my standpoint. You know that I've said many a time that this continuous reluctance to move interest rates higher and this so-called transitory inflation that everybody spoke of, they might find that the inflation applies for political asylum and then stay much longer than was anticipated. And I think that's exactly what's going to happen. And the only way to get rid of that is to actually raise your interest rates. Now, I think that's one of the reasons why we are seeing that the longer yields in the Americas are actually rising a little bit on the back of last week's employment figures.
Isn't it too late to now look at raising rates to curtail inflation? As I said, hasn't the horse bolted, so to speak?
I think the horse is on its way to the stable, yes, but I don't think it's ever too late. I think there's always room to maneuver and there's always room to change things. But you need the willingness of people to do that, and that's what we're missing at this point in time. But I don't think it's too late to actually do something to stop and curb any runaway inflation throughout the world.
What does this all mean for the rand, Andre? So we've been teetering around that 15 to the US dollar level. What are your forecasts? Have they changed from our recent discussion where you were looking at a range around about the 1450 level?
I'm still retaining my view and keeping my view firm on that for this year. Going into next year, I think we could see a change and move up above the 15 level again, and then move into a 1520 to 1570 range quite early in the new year. But I want to get back to the inflation situation and interest rates. I sometimes wonder whether our central banks are not afraid of seeing stock markets actually declining quite significantly and losing a lot of value and wiping out and incurring quite a lot of big losses for a lot of people. Because I think stock markets might be slightly overinflated on the back of the low interest rate scenario that we've had for so many years. And I think that's one of the reasons why these people are so reluctant to change all of that. as it might have a very negative impact on stock markets if people start moving out of this overload of stocks into cash markets. So not too late, and I don't think a correction in the stock market is entirely an incorrect thing to happen.
Well, let's talk now about the risks out there. And of course, the energy crisis is large in China. And again, this has got a number of investors hot under the collar, anticipating that there will be a bigger fallout globally, that together with the Evergrande, the real estate issues in China. We know Fantasia coming to the fore as well. What's your take on the news flow coming out of the East?
Well, if you look at the gearing of companies and debt in companies in China, then it stands at horrific levels as a percentage of GDP. Not a good thing at all. And that ties in, and then the whole Evergrande thing comes back to, the gearing of companies. And on top of that comes an energy crisis where people will have to cut back on manufacturing to get out of that, because they will also have the same situation as we do, with a negative impact on growth. And that negative impact on growth will compound in terms of the gearing of some of these companies. And hence, that will be negative for emerging markets. But then, as I've just said a little earlier, that's why I say that in the beginning of next year, quite soon, we will see the rand breaching 15 levels and go into the 1520 to 1570 ranges on the back of weaker emerging markets and those concerns coming back to the forefront.
And oil and the energy crisis, obviously we're looking at, around about that $80 barrel level, and many forecasters saying it's going to remain stubbornly high for a while. Given all the talk around the energy crisis, is this something that you are looking to in terms of giving direction to the rand? Obviously, we have that commodity underpin, but now we've got a double play almost coming to the fore. In some instances, you've got weaker commodities, but oil is rising.
That's very negative for our economy in terms of the large amount of oil that we import and the impact of that on our fuel prices. And fuel is used in the logistics sector. It's used throughout the manufacturing sector. So a dramatic impact and negative for our inflation rate, because that we could see increase. And that could bring, from a monetary point of view, an increase in interest rates a little bit closer to being implemented than what is expected. Now, the interest rate increase as such would be positive for the rand, but longer term it would be very negative for the economy and in terms of growth. So it would be a small impact on the positive side for the rand and largely a negative impact going forward.
Well, the local government elections are looming ever closer, and that risk is not out of the window. Andre, is it becoming a keener risk in your opinion, or do you think that we are going to sail through those local government elections with very little trouble?
The further we get closer to the 1st of November, it is my idea, if I look at the news media, I look at social media, I look at what's happening around us, then I say that risk is actually subsiding slightly in terms of breaking to the negative side. And I think we can move that negativeness that I have foreseen in that area to a neutral stance at this point in time. So I don't think that will have too much of an impact on the currency at all. The election results might be interesting afterwards, but I don't think that will impact on the currency at all.
Well, you've mentioned looking to breach that 15 level to the top side in the new year, 1520. But are there any other risks in the environment as we get closer to year end that could cause a blowout? I mean, obviously now you've parked the local government elections to more of a neutral impact on the local currency. Anything in particular that you have your eye on that could be the next red flag?
Locally, nothing really yet. I'm happy with what happens locally in South Africa. It's the international environment. It's any announcement by the Federal Reserve on tapering or interest rate movements. And then obviously, as we've spoken a little bit earlier about the whole Chinese gearing of companies and the energy crisis situation within China. Any further negative influence on that side will be a negative risk towards the rand. If that stabilizes, that will be further positives for the rand.
Andre, always a pleasure. Thank you so much for joining us here on Biz News. Andre Cilliers from TreasuryONE.
Pleasure. Thank you.